Hello folks, and welcome to the Australians Money Cafe. I'm James Kirby, Wealth Editor of The Australian. And now, just before we kick off today, I must tell you something in the way of what you might call a community announcement. You've probably seen that Alan Kohler and I won't be doing the show any longer. Alan won't be doing it with me. We're still very good chums, but our arrangements changed this year. And look, basically it became all too difficult to keep rolling as we were. So what I've been doing is I'm bringing you a short series of special guests, and then pretty soon we'll have some big news as to who actually will be my new co-host. Though, of course, we'll have regular guests on the show. And today I have someone who I think had one of the biggest responses that we ever had on the show with an advisor. It's Will Hamilton. He's from Hamilton Wealth Management in Melbourne. A veteran, Will, I think we can safely say a veteran of the top 100 financial advisors list, because he was there the first one, and there's been 5 of them now. So, Will Hamilton, how are you?
Very well, James, and thank you for having me. Appreciate it.
You're very welcome. Good to have you on. It's actually, I was just thinking, I've got one of the top financial advisors in the country. In the last week of the financial year, when you can't get a financial advisor on the phone for love or money. So you must be a very organized man.
No, well, we call ourselves a wealth manager. I think the thing with us is we look after sophisticated investors. So
yes,
we are lucky, so we don't get involved in as much of that end of year thing that is a number do. Yeah.
Yes, yeah, and of course you have all your sophisticated. Actually, talking about sophistication, I do have a piece running at the weekend, and it's by Rodney Horan. He's a financial advisor, and he's actually saying, this is a piece that's going to appear on Saturday, but he's saying that he thinks the whole sophisticated advisor scene is being abused, basically, and that the amount of money you need to be to be defined as such is too low. I know a lot of people love to be called a sophisticated investor, but in reality, of course, you don't have the protections that mom and dad have when you're a sophisticated investor. So there's probably a good sense that may be changing. Do you think that they will make some changes to it?
It's been a big debate for a long time. It's up to ASIC to have a look at it. We haven't seen any sign of that at this stage. But look, it's not just about the strict legal version. You can have people that have $30 million.
Yes.
And legally, they are a sophisticated wholesale investor. But they aren't on a generalized basis. That may not be there. And you have to, therefore, treat them as not sophisticated, so to speak, yes. And you need to increase what you go through with them. And I think that's where, just by taking a pure legal stance, that's not the right way to look at it.
Yeah, I suppose that irony will always be there. I mean, you could have a professor of econometrics or something who doesn't qualify as a sophisticated investor, and you could have a very dim lucky person who inherited a lot, and they're sophisticated by law, but not in reality, perhaps. Is that am I getting into dangerous territory, or is it broadly fair?
No. Look, I think that this is part of the debate. But look, we have some wealthy clients that we increase that level of information to, because this is a new world for them. They might understand property, they might understand the business that has made them the money, but when it comes to our world, they're ignorant about it.
Yes, yeah. Well, now, as you know, Will, our audience here in the Money Cafe is all terribly sophisticated, though not necessarily legally categorized as such. And because I've got you, and it is the last week of the financial year, is there anything, I know you work at a very high level, very wealthy people, but is there anything glaringly obvious that you think people could do, should do, often don't do, and they've got a week left?
Look, this is on the investment side. So in particular, this is going to be one of those years that we go through every now and then, and people often look at the capital losses, etc. There won't be too many of them this year. I'd be very correct. I'd be very surprised if there are. The markets in all asset classes have performed very well. This has been
hard to lose money. Hard to lose money.
Correct.
This year.
Yeah, it's been a strong bounce, a very strong bounce. And I think people are going to be surprised, especially if they're invested in managed funds, the size of the distributions they're about to receive. So you've got to remember, a trust is a structure where if they've realised capital gains,
Mm.
they will be distributed. So
Yes.
it's not just the income; it is the gain. So I think, and if you're in hedged investments in global equities, because of the contracts they've got and the fact that hedged to the end of May is outperformed unhedged by about 14%. Now, they've probably given back actually all of it, probably about 5% this month, I'd say, given
Mm.
the Australian dollar's fallen.
Mm.
But those contracts have thrown off a lot of
Yeah.
income as well. So you're in for some big distributions. And I think people haven't prepared for that. We had a client in the other day said, well, last year I had this, and therefore this is going to be my income flow
Mm.
for this year. And we said, no, 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 it's going to be a lot higher.
Right. So the
Um,
good news is you're going to have more income. The bad news is you're going to have more tax. Is that?
Correct.
Yeah.
Yeah, and one thing you've got to look at in a year like this is back a few months, we stopped investing because you don't want to invest, say, at the beginning of May and then effectively inherit someone else's tax,
Mm.
someone else's gains. So
Mm.
that's something that I think a lot of the advisors just held back a little bit. Yeah,
Yeah, right. That's an interesting. Yes, and just one other thing. I suppose the dividends will be big, and there'll be some chunky dividends coming through. I mean, Rio and companies like that. They're really
yeah,
making a
yeah.
good
And I think
contribution.
just remember, companies cut back their dividends last year, the year, in 2020 as well. So you're seeing increased dividends, and we one of the things with the Australian economy, our business has been going for 8 years, and we're overweight Australia. And I think this is probably the first time in 8 years we've been overweight Australia. And we are a cyclical economy. I don't like
Yeah,
this argument value versus growth and all that. It's the
yeah,
cyclicals,
yeah.
and we do have things that come out of the ground. We do produce things, and you can't just produce a new mine.
Mm.
It's very difficult.
Mm.
And so what you're seeing with these companies, and you just mentioned Rio, that's margin increase.
So when it comes right, it really comes right. Is that what you mean with the
Sure,
cyclicals?
absolutely. And
Yeah.
I think this is going to continue for a little while.
Yeah,
Yeah,
yeah. Well, that's interesting. Well, Rio and BHP, of course, sort of occupying, in some respects, the place that the banks occupied, where they're just literally pouring out the dividends in the this year and next year too. The other thing, just on that issue about it being the end of the year and July 1 coming up, on super, there's some big things, isn't there? I mean, there's the SGC, first of all, which everyone's going to get if they work at all. That means 10% of your salary is going to go into super now. And you can contribute more, and the cap goes up. Is that? Do you think? Is there anything people should watch there?
um, I think a lot of people are probably, a lot of employees are actually unaware that it's not, they're going to get a pay cut in their take home pay, because superannuation contributions are going down. Some companies have made that up, some haven't.
Yeah.
Um, and I think some people are unaware of that. But I think the big thing is make sure in 2022 tax year, if you can afford it, you do increase the concessional contributions. And if you're looking at non-concessional, one of the big things is to look at the 3-year bring forward. We're seeing, and so, rightly so, is you do 1 year this year, and you've only got a week to do it because as of the 1st of July, that goes up to 110. So
Right. So
don't do the bring forward at 100. Make sure you bring forward at 110.
so wait for that to happen.
Yes,
Yeah. So
absolutely.
just to, I mean, I'm sure most people know this, but the mechanics of all this, folks, is that how much you can put into super pre-tax from July 1 goes up from 25 grand a year to 27 and a half, and what they call the
Non-concessional.
non-concessional being
Yep.
post-tax goes from 100, you can put in 100 grand a year to 110, which is very useful, I'm sure, for many people. And of course, there is the thing, as you were saying, well, some companies will say, oh, sorry, we've got to give you an extra, we've got to increase your super. So your package stays the same, but your take-home pay is going to have to be pinched a bit. Now, but we see some companies, I see, Commonwealth Bank, Price Waterhouse, a few of the big companies are saying, actually, what we'll do is we won't change your take-home pay at all. We'll put through the super increase, and your total package is actually going to go up. Do you think there's one of the things I came across during the week was very interesting? It's from ASFA, being the Association of Superannuation Funds. who of course lobbied for this increase in SGC. But they made the point that the last two times there was an increase in the SGC, in the superannuation guarantee charge, that wages went up both times. And if we have more companies like Combank and PwC doing this, do you think there's a chance that it may actually, though the people who were against this said there could be all problems with wages, do you think that wages, there could actually be some lift in wages here and there off the back of the improved, increased superannuation charge? With companies just say, I don't want to lose anybody, I don't want anyone to be unhappy, let's just give it to them.
Well, we have effectively done something. It's not I look at our own business. We've brought in a wellness package and with a certain limit pre-tax per annum. So we're doing that to adjust at this time, because look, there's no doubt our industry, it's hard to get good people, and there's a shortage of staff. I was just talking to someone in the legal fraternity this morning, and she said that's their biggest issue, and it's pushing salaries up. So I
Professional
think that
services.
correct. It's demand is strong. Demand
Yeah.
for good employees is very strong, and I think that you have to meet the market, and if you're not doing it that way,
Yeah.
and as we know, the pain of losing an employee and then having to go and find a
Yeah,
replacement.
the
So
toil of replacing them. It's interesting because
correct.
ANZ,
Yeah.
for what it's worth, so far have said, no, 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 sorry, we can't do anything. We're just going to have to cut your take-home pay to get this increase in. But so far, Will, it seems to me that the conditions, perhaps, that this is going through are different to the conditions when the debate was on about whether they should do it or not.
hmm
Yeah.
I I think the one thing, look, you and I have been around a little while, James, and
Yes. Oh, yes. A long while.
and
And we remember everything.
I think the one thing that we all have to admit is that if we look back at COVID, none of us have been through. We've been through corrections before, but we've never been through a pandemic. And I
No.
think that we have to concede that. Well, I know there's some things that we misread, and that's because of I've never gone through a pandemic before. We've never gone through the degree of stimulation that governments put
Yeah.
out there. This is unforeseen.
Yes.
It literally was, and this is new times. And the one thing I've definitely taken from this is, and we have adopted, and we adapted last year, in the middle of last year, is you have to be flexible. Flexibility is an absolute key. You think you're going down a certain road, well, be prepared to change the direction.
And so, like, as an investor, then, is there, I mean, there was always, it was so easy. I won't say easy, but at least for a while there, you had a narrative, for want of a better term. And the narrative was whatever else is happening, rates are going nowhere. Rates are going nowhere. You can make all your plans, and they're not going to change. Not going to change for 3 years, they were telling us at one stage. Now, that's at the very least wobbling, I think, as a narrative. But what do you think? I mean, what do people should base coal, should people be prepared for higher rates and higher inflation, whatever the running theories or debates of the day are? Should people be prepared for it?
So the debate has gone from, is inflation transitional, to to systemic. So is it embedded in the system? And a client of ours, for instance, we had a review in Sydney just before the lockdown, and that's the Melbourne lockdown. And it was interesting. He was telling us about the price of lumber and how that had affected their business and pushed up costs. And I just
Yes.
hadn't factored that in. And these are inputs. So we were talking at the very beginning of this podcast about resources and
Yeah.
and they're inputs. Lumber is an input.
And if
Soft
you pay more,
soft commodities are inputs, and they're
yes,
all up.
and if you pay
And
more for them, you gotta somehow pass it on.
correct.
Yeah.
Now, inflation. I've said through the world section of the Australian, where there's only two ways out of what the degree of government stimulus that we've seen, and we either have to increase taxes or we have to inflate our way out. A little bit of inflation in the system is not a bad thing. Be it 3.5%, 3.5%, 5%. I think is too much. Definitely too much, and that's where you'll see the world panic. 3.5%. I think the world can accept that. Even at 3.5%, though, we will see some higher interest rates. And the one thing, but will that rock equity markets? I doubt it. 5%, yes, I think
Right.
we could see
So
some.
we could, yeah, a bit of inflation we could handle.
Yeah. The confusing thing is though the inflation figures that have come out, and we saw bonds rally lately.
Yeah,
U.S. Treasury's down to 1.4%, and they
yeah.
rallied, and you're going, hold on, this doesn't make sense. So the
No,
bond market at the moment is telling us, looking ahead, they don't believe in systemic inflation.
but markets often don't make sense, Will.
No.
Yeah, you see, that story could change tomorrow. Just
Tomorrow.
I'm just playing with you here, but it's true.
Mm,
All right, now actually, yes, that's interesting about the inputs, but they're all so this inflation, to the extent that it's here and we're starting to see it, it's all so far, it's about um, raw materials, isn't it? It's not
yeah.
about wages. We haven't really seen it come through in wages.
And
Uh,
and semiconductors, which people don't, that's what goes. These are the computer chips in your car and your phone,
yes.
and that's about a drought in Taiwan. That's really what this is about.
It's extraordinary. They haven't
Yeah,
got enough water in Taiwan to
correct.
cool the air conditioners for the semiconductor factories that supply the world. Is that it?
That's the big
Oh,
thing.
gosh, isn't it fascinating that on top of everything else, not just that crazy story about the drought, but that it's in such a politically delicate area that world. What about all the American chip? What about the Intels and the AMDs? Did they fade then in recent times?
No, no, I think the big thing is the volume that comes out of TSMC in Taiwan. This is
Right.
they are the biggest chip producer in the world, and it's a very large percentage of total chips. So
Yeah.
TSMC is dominant in that space, and that's what it is. And we're now into typhoon season, etc. In northern Asia. We're entering that, as you know, having lived there, and
Yes.
this is the time of year where it starts to rain. I think they will be crossing every finger, toe, etc. in Taiwan and hoping it rains.
Gosh, yeah, it's extraordinary. It reminds me of that book. What was that book? If a butterfly, something or other, flaps its wings in the Amazon, what does it do for Starbucks coffee price? And it's that sort of that everything is integrated, and the speed, I suppose, at which it all links up now. Okay, I think because I've got a really terrific line of questions and I have you with us this week, I think we will go to questions. Will I'll just first of all cross and we'll hear a word from our sponsor this week. Hello, everybody. I'm James Kirby, wealth editor at The Australian. And on The Australian's Money Cafe this week, I have Will Hamilton. Now, I introduced him at the start, but if you missed that, he's Will Hamilton of Hamilton Wealth Management and a very well-known financial advisor across the nation. Now, Will, can you see the questions
I
on
can.
your piece of paper there? From the first one's from Michael. Would you like to read that question?
Yeah, so Michael asks, I hear you speak about self-managed super funds and other superannuation tools methods a fair bit, but I haven't heard you cover indexed investments within super. So his first question, one of two, considering these typically have very low fees and still perform quite well, would you be comfortable using them?
Hmm. Yes, it would be my short answer to that. Of course, nothing wrong with them at all. I'm skeptical that they're the answer to everything, but gee, there's nothing wrong with them at all in a super portfolio. Mm.
Yep, there's nothing wrong at all. And, just because they're in a self-managed super fund environment doesn't mean you preclude them. If that's
Mm.
what you like, you can definitely look at them. Michael's second question is, are there any other super fund tips you would like to share with your younger listeners?
That's for you, Will. What do you think?
Put as much into super as you can,
Well, yeah,
because going forward from the 1st of July, you can have 1.7 million in there. And if you look at the regulations and also look at, Michael, I don't know your age, I don't know what your salary is, but you're going to have to save very hard to get 1.7 million in.
yeah.
And
Start
just
early.
remember, and just remembering the tax environment. It's a tax arbitrage. That's what it is as an environment.
Mm.
That's what superannuation is. So
Yeah.
using those concessional contributions, which go from 25,000 to 27,500, it's
And
get
get
as
get
much in there.
and Michael, get your employer. It's no problem. Every employer will do it. Just say, I want to. I just very flatly, if you're on 100,000 a year, I'm just using this because it's easy. You're allowed 27,500 to go into super each year. Now you wouldn't do that, but just for the maths of it, what you do is you get your SGC. That's 10% of the 100,000. Okay, so that's 10,000 gone. but you've got 17 and a half more that you could put in. Now you don't have to put in that much, but any part of that you put in is on a big tax concession. It's 15% rather than you could be on 45 for all we know. So you get a great saving there, and I think a bit like paying a mortgage will. Um, it's a great discipline because you
It
don't
is.
notice. I mean, if you have to hand over the money, you notice. But if you don't ever get it in your take-home pay, and the years pass, the next thing it clocks up. Uh,
And the other tip I think is important and that's come about recently with government legislation that's been forward, is just make sure your return is satisfactory against its peers.
mm, mm,
And yeah, there are some funds, unfortunately, that have underperformed relative to their peers. And it's not about 1 year performance. Never look at 1 year performance in a market that we've just gone through. Look at 3 and 5 year performance.
yeah, yeah, yeah. And actually, one of the worst things, of course, is that the underperformers are the same gang over
Mm,
time. And once upon a time, it was a bit of a mystery about this, but not anymore. You can go on to the APRA heat map, and that only does my super. But it's a pretty good way to get a steer on who's good and who's bad in the industry. And there are certain funds that are consistently at the top and others that are consistently at the bottom. So yeah, you don't want to be stuck in one of those, or indeed stapled to one, will, for the rest of your life. Which is the new thing, of course. The first super fund you pick is with you forever unless you choose to change. And most people never choose or don't engage with their super. Okay, Josh says, we have a limit of 1.6 million that we can transfer from super into a pension fund once we retire, right? Right. And then he says, if we exceed the target, what's the incentive to put as much as we can? Is it worth aiming for more? The answer to this will help so many people in a very general sense, says Josh, implying usefully that not everybody has 1.6 million. Indeed, Josh. So the short question is, Will, if you were lucky enough to hit the 1.6 and you could
put
still
more in if you
contribute,
can.
would you put any more in?
If you can, yes, because you've got that in retirement phase, which is at zero, but anything above that, you will still be taxed at 15%. So it all depends what your
Yeah,
assets are outside. And I think
yeah,
that's the answer to this,
yeah.
because if you're going to be paying outside of super any more than 15% in tax, you definitely would have it in there. Because also remember that when you hit retirement phase, you can take it out. Yeah,
Yes,
so you don't need
yes.
to take them. It's not the minimum is not the maximum. If you get my drift, you can take as
Yeah, yeah.
much out as you
It's
want.
important
Yeah,
people forget actually.
yeah.
When all the focus is on accumulating, yes, of course, that you can withdraw it because you're retired. All right. Now, I like this question from Luke, but you can read it out there if you would.
Yeah. So, Luke, I'm seeing more and more press regarding the stock market and its inflated prices. So, Michael Burry has called it the biggest market bubble in history. Jeremy Grantham suggesting we're in a bubble and it's serious. Robert Kioski is buying up physical gold and silver. What are your thoughts on where things are at, and where are you looking to sell any of your positions in the market? There was a really good article in the Australian last Saturday on this.
Mm-hmm.
And I think we also need to look at interest. Always look at interest rates. It's one thing I've repeatedly said time and time again. Now, when interest rates peaked at 16, well, we're near their peak at 16%. The S&P 500 was at 8.5 times. Today, it's at 30
Okay.
times. And I
Yeah.
think it's about interest rates. So if we do see interest rates go up, we will start to see some of that market valuation coming down. But you I don't believe at this point in time we are in danger territory. I think that there is a shortage. Whilst interest rates are low, and even if they were to go to 2.5%, 3%, that's still low. This is part of this lower
So,
for
what would you
longer.
think is normal? What would you think is
The
normal,
biggest issue for
comfortable range?
people, well, the biggest issue for people at the moment is getting income,
Yeah.
and I actually think the stock market is liquid. Yes, there are good quality companies there, and I think this gets down to making sure you're buying businesses with cash flow and earnings. And some of these more tech-oriented businesses are not cash flow and earnings. So they're the things that are going to be less volatile. They're the companies. The companies that are looking at sustainable dividends, sustainable earnings. I think that's important. But don't. And there's a couple of things that have worried me in the last 12 months as people have rushed towards some diversified credit products and probably put too much in. In fact, the interesting thing is we've been in diversified credit and the property part of that for 8 years. We've actually decreased our weighting to it in the last 12 months, which has been a difficult decision. But when we were getting 11, 12s, that was a really easy decision. When we're getting 7, 8s, I know some people might say it's a great return, but the risk return trade off, and that's what you've always got to look at. Is the risk worth it for the return I'm getting? So we've been looking at other things, and I think that there's that and illiquid assets. I get worried when illiquid assets are a great part of a portfolio and we've got them in there and they provide a dampening and volatility, and we've had them again for a long time, and especially during COVID, they were real positive to our total return and volatility of our portfolios. But I suddenly seen products, and I think you and I have talked about this on the phone in the past. When you're seeing these liquid products with liquidity sleeves, but they're global products of which the Australian fund is a feeder fund into it.
So basically, we're talking about these big funds that were marketed to people who were worried. And they're saying, look, hey guys, you're getting nothing in your cash in the bank. Come over here. We've got a fund that's a debt fund, a credit fund, and it's going to pay, much more. And it pays 3 or 4%. But the point you're making is you're taking a lot of risk for that 3 or 4%. Is
Yeah,
that it?
it's important to have look. There's been no, as I just said, we've had exposure to some of these products for 8 years, but just make sure that it's balanced properly. And if you're going into something which is a global fund where it's a feeder, just make sure it can't get locked up because of so they're locked up so you can't get your money out, even though they've told you there's a liquidity sleeve, because of the actions of someone in the UK or another domicile.
So these funds where people are going into new areas that they're not used to, beyond shares, though they're listed on the stock market, you have to be very careful because it's an area that really, in some ways, it's a bit of a game, putting what's supposed to be not on the share market on the share market.
Understand what you're investing in other words.
Yeah. Okay, very good. I'm just going to jump down to the next question. I'm going to go to the question from Luke Will, and he says, I need an opinion on the first home super saver scheme. We've learned more about it each week for a few weeks now. You can put money into super and pay less tax because of salary sacrificing. And then you can take $50,000 out at the far end of the first home super saver scheme to buy your house, which is useful, I suppose. Now, Luke's question is, but what about the tax you have to pay when you take the money out? Is there actually any tax savings in the end? Yeah, you see, these things get a lot of attention, don't they, Will? And people get excited. But I mean, it seems to be worth doing, but you're not really. You're saving a bit, huh? Is that it? Is it worth
Again,
doing?
it's a tax arbitrage.
Yeah, but is it a tax
And
arbitrage worth Luke's
it's
time?
very look for someone like Luke. You're allowed to put, I think it's 15,000 a year in from memory. It's
That's
something
right.
I'm not an expert on this, but I think you're allowed to put 15,000 a year. So if you're not having the your concessional contributions, have only taken 10,000 out, you could be saving roughly, maybe $2,500, $2,500. The important thing is to get the paperwork right, from what I gather. That's very, very important. So because if you don't get that paperwork right, it will be seen as non-concessional, not concessional,
Yeah,
and
yeah.
it's important to be able to get it out.
And very important also, and this is not for Luke in particular, it's not personal advice, never is. However, it's very important to remember that scheme. It's worth doing on balance if you're saving for a house and you're close, but make sure that you understand that you can only use your voluntary super contributions, not your SGC. See, so what we were talking about earlier on about the guy that had 100 grand, and if he wanted to if he wanted to go into the first home super saver scheme, for instance, how it would work is he'd have to put his 10% of SGC, that's 10. The maximum you can put in is 27 and a half. So in that case, the person could, in theory, put up to 17 and a half. They'd have that it's in that amount that they can voluntarily put into super is the pool from which they can use this scheme. That's important to
Correct.
know as well. It's not your off the shelf super, if you know what I mean.
And I
So
believe getting that paperwork right is really
yeah,
important.
have you heard something of someone getting it wrong or?
No, I've just been, look, I inquired for someone else and I was just stressed, it was stressed to me. There is some paperwork, especially with some of the industry funds, but I think you'll find, being, we're near the 30th of June, that most of the industry funds may have shut the door on that for this year. So this is
Right.
really a 2022 equation
Yes.
for many people. Yeah.
Okay, and of course the expansion of that scheme in terms of the number of people that are allowed to use it, all those things kick off on July 1. Okay, very good. Now, last couple of questions.
Yes. So,
Jeff.
Jeff, I enjoyed the recent episode with Stuart Weems. One of the things touched on by James in the Week in Australian was the ATO revelations about how much people pay in tax. Like most PAYE taxpayers, I'm constantly frustrated that high income earners can use trusts and companies to split taxable income across multiple companies. Low income or non working children, why won't either political side tackle the big end of town's excessive tax advantages?
What do you say to that, wealth advisor?
Well, I did write quite a number of articles on Bill Shorten's tax proposals, and I think one of the things that I'll probably take issue with what Jeff said is that the number of people that use these structures aren't the big end of town. They are tradies. They are people that have shops up and down the high street.
Yes.
They don't take a salary. They split income and take a distribution from these trusts.
Mm,
I'm not saying that there isn't the big end of town that
mm.
don't look at this, but the majority of people, these are very hardworking individuals,
Yeah,
and this
I
is the
have no
way they
problem with
pay
that.
themselves, and I have
Yeah,
no issue with that whatsoever.
interesting you say that, Will. And also, I mean, the one thing I would say to Jeff is that these are open to everyone. Anyone can use them. It's about getting across them, understanding them, and looking at your situation and seeing if you can. I know on PAYG or salary, it's not as easy as if you were a tradie making piles of cash. Sure, but there are things you can do. I'm on
And I do
salary.
believe the ATO has cracked down on Everest trust structures, which is how a lot of the
Mm,
professional firms compensate people beyond salaries. And you cannot split 50-50 anymore.
yes, right, right.
So again, the ATO has cracked down on that. And I think
Mm.
again, I'm not a tax expert, but I think it might be 70-30.
Right. But I was saying to people, even and I've said everywhere I go, okay, if you're not on a straight salary, there's lots of things you can do. You can contribute to super, for instance. You can get a car on novated lease. There's investment
Yep.
bonds. There's a variety. There's co-contributions. If you're within a couple, etc., there's a lot of things you can do, and it's true. The more money you have, the more useful these things are. But they are open to everybody. And the other
Yep.
thing is, those ATO surveys show that often, actually, the top people in terms of those who pay tax are not certainly. It's not the tradies that come up on the list. Will
No.
It's the neurosurgeons and the dentists and the psychiatrists,
Yep.
probably because they have the least wriggle room, I expect, and everything is so transparent now in the health
Yep.
system. Okay, last two questions. This is from Neil. Interesting question from Neil. Do you think the price of cars and other vehicles will go back to where they were before COVID, or is this the new normal? I mean, apparently, second-hand car prices have gone out the window because nobody was changing their cars. I see the US, the average age of a car is 12 years. I don't know what it is here, but second-hand cars apparently have really mushroomed in cost. Whether they'll go back down, what do you think?
I think one of the issues is, look, a friend of mine has got a major car dealership in Melbourne, so multiple brands, and as he said, there's no shortage of buyers. The problem's supply. and people try and negotiate. He said, "Look, all you're going to get is a set of car mats."
That's all you're ever going to get.
Yeah, but
I never got more than that.
I hope he's listening. And look, eventually, and one of the issues why there is a shortage of supply is again semiconductor chips, as we talked about before.
Really?
Yeah,
That's right.
because
I see.
these vehicles have those things in them, and so when the supply of new vehicles comes out and balances out, then you'll get second-hand car prices even out as well. So that's one of, look, I don't know. I'm telling you this anecdotally, but people say that if you've got a 12-month-year-old Land Cruiser, you'll sell it for more than you paid for it. You have to wait about 2 years for the new one, but anyway.
How about that? Well, that's interesting. Okay, and I find this a segue, an irresistible segue to the piece of news, of course, during the week that the electric cars have now, in New South Wales, you can get up to $7,000 off an electric car with the new scheme put through by the New South Wales government, and $3,000 off an electric car with the new scheme from the Andrews government in Victoria, which tells me two things. One, at last, we're starting to tune in to the global electric car situation. And the other thing is, usefully, both sides of politics are now involved. So at least it's no longer a political bun fight about electric cars, which it never should have been. Okay, final question from Hamilton. You want to read that one?
Yes, there's a lot of talk arising from housing construction leading to a profitless boom. What are your thoughts on the supply side shortages and what companies would benefit from the most from the increased demand?
Kerry Stokes would tell you Boral is one.
Yeah, it's amazing just the stories you're starting to hear from people doing renovations or building and the delays or even the changes they're having to do in design because you can't get X beam. I hear the shortages of LED lights, things like that. It's amazing, and this has got large consequences. Again, it's squeezing margins in the building industry, and I think again, this is just part of the process we're in. We are in extraordinary times. Who would have thought a year ago this is where we would be?
Yes, I know. You'd have to be very bullish and have great fortitude to plow in this time last year into the building trade. But so is that necessarily good for building companies, the Borals, the James Hardys of this world?
If they can increase margins, if they can, of course you've got to sell X, still the volume has to be there, but if you can get the volume with the margin, that's a very positive outcome. And a lot of it is the inputs, you still need cement, and I'm sure that those margins just increase, as simple as that.
Yeah, it's fascinating. It is, and again, there's that inflation sort of, scenario again behind so much. Even you think about the questions today and that notion of shortages, etc. Inflation is on the agenda. We don't know how long it's going to last, but hey, it's arrived. Okay, well, thank you, Will. That was marvelous.
You're welcome, James.
I knew it would be, and great to have you. Very considered expertise there from Will Hamilton on some of the questions we've got. Keep the questions rolling in, folks. All types of questions are welcome. And remember, the email is moneycafe@theaustralian.com.au. Okay, thanks for listening to today's episode of the Money Cafe. Send in the questions, as I say. We'll aim to read every single one of them out. I think we managed to do that in this last week and possibly the week before. Tweet. You can use Twitter, of course. I see some questions coming through. I haven't picked those ones up yet. I will. And until next week, I'm James Kirby, Wealth Editor at The Australian. Will Hamilton of Hamilton Wealth Management. Thanks a lot. We will talk to you again.